When we started talking about adjusted entries, I came up with this table on the left-hand side where we covered all the 4 different types of adjusted entries, which are prepaid expenses, accrued expenses, unearned revenues, and accrued revenues. But I realized that we are actually kind of leaving out one last one, and I'm kind of ruining my beautiful square over here. But I'm going to add a 5th one, which has to do with amortization and depreciation. So let's get right on that. And I'm going to be talking about one thing, and that is the difference between depreciation and amortization before we actually go about creating the entries. So, what is the difference between this very confusing 2 definitions? So we have depreciation and amortization. So depreciation usually has to do with looking at the physical or the use or consumption of a capital asset like equipment or property or a car. So it shows the depreciation of a physical asset. While amortization is a little bit more of a powerful term because it can represent the depreciation of a physical asset, but it can also represent the depreciation of an intangible asset, which is something like a logo or a patent, so some type of intellectual property. And that's why we more commonly will use amortization when we're talking about depreciation or when we're creating a depreciation entry. So for the most part, you can think of, in this tutorial, you can think of these terms being interchangeable in that they mean the same thing, but you probably want to use the word amortization, and I think your profs will probably make you use that word for your entries. So let's actually talk about this last adjust entry so we can get it off our backs and start something new. So what I thought we'd do is I thought we'd use a very relevant example in which we're talking about a piece of equipment known as the Batmobile, because it's very relevant in this time and age because the Batman movie just came out, or the Dark Knight, whatever you want to call it. So this is not the new one, obviously. This is like the 1990s kind of unusually long Batman drifter, and let's say that Batman purchased this awesome vehicle for $600,000 on the 1st of August. So he purchased this on the 1st of August. What are we going to do right away once he purchases it? We're going to actually show the recognizing entry to recognize the asset. So we're going to show a car as a debit because we're gaining an asset, and we're going to show the use of cash, and it's going to be for $600,000 on the debit and credit side. I just don't have enough room there, but you know the debits and credits. And let's say it's the 31st of August now. What's going to happen? We need to show something. This is where the adjusting entry comes in. So it's the 31st of August, and let's say Batman, obviously, even though he's so busy fighting crime, that he needs to come up with his income statement, see how he's doing financially, kind of check out his performance for the month. So, of course, you know the income statement made up of the same thing, like always, revenues and expenses. So let's write those down. So we have, I'll just create a new layer. Let's say that he has revenues, kind of like his security revenues, I guess you can say, provides security for the city, and of course he has expenses. So let's say he reported all of his expenses. Maybe he paid salaries to all of his employees and any other costs, utilities for his huge bat lair and everything. But the one thing he didn't include was amortization, because he had this car purchased and he hasn't reported anything on the 31st of August. So what we're missing is amortization expense. And if we don't report it, once again, our expenses will be understated. So we need to report it on the 31st. So what's going to happen is that we need to show the use of the car for one entire month. So how are we going to do this? Well, I forgot to leave something here, and that is the car is going to be used for 10 years. So right now, this might be kind of brainstorming a way to do this, and that would be to take the $600,000. I'm just gonna kind of erase this over on the right side. We would take the $600,000 and we'd divide that by 10 years to get how much amortization we're gonna have per year. And then we're going to take that amount and divide it by 12 to get the monthly amortization expense. And there we go. We got $5,000, which is how much he's going to report every single month for the usage of this car, or this drifter, whatever you want to call it. It's kind of got wings and stuff. But anyways, on the 31st of August, he needs to report $5,000 of amortization expense. What are going to be the two accounts that he's going to use? Well, if we were to look back at the rules, I got them somewhere here. I think there we go. Let me kind of shrink it down a bit so it isn't entirely crashing into the stuff on the right side. So, adjusting entries are all about revenues and expenses. So, this is going to be a revenue adjusted entry? No, it's going to be an expense adjusted entry because we need to show the expense on the car and the usage of the car. And once again, these adjusted entries don't involve cash, and they need to show the passage of time, which is for 1 month in this case. So, if we're not using cash, what are we going to be using as the accounts? Well, the first one is an expense, because this is an expense adjusted entry. And in this case, we're going to have amortization expense as the debit. And it's going to be for $5,000. And the other account that's going to be credited, it is kind of tricky, and it is called accumulated amortization. I don't have enough space to write it on the same line, but it is the credit, and it's going to be $5,000. So what is this random account that you've never heard of? Well, accumulated amortization, what is it? Is it an asset? Is it a liability? Is it an equity account? No, it is something what is known as a contra asset account. In contra asset accounts, what they do is when the contra asset account increases, the asset account will decrease. So when accumulated amortization, when that account increases, our asset of a car is going to decrease. So remember that the contra asset account always sticks to the asset account. They're kind of like best friends. So if you have the car account, you'll always have accumulated amortization right underneath it on the balance sheet to show maybe that. So we have $600,000 of a balance for the car, and then our accumulated amortization would be like $5,000. So the net value of the car would be $595,000 after 1 month. So they stick together, they're best friends, and this is the way we show the adjusted entry to report the usage of the car for 1 whole month. And that's all you do. So just remember that the contra asset account, which I've talked about right here, is that basically it kind of offsets the asset account. So remember, one last time, when the contra asset account goes up, the asset account decreases in value. So that's all I wanted to cover in this tutorial. Make sure to check out the next one. We're going to be continuing on with the accounting cycle. I'll see you guys in the next one. I'm sure you guys have questions regarding accounting topics or our videos, so make sure to tweet us at #iNinjaNotes, like us on Facebook to receive updates or to share any quick anecdotes about how our videos might have helped. And like always, thanks for watching us on YouTube.